who doesn't have a whole lot of assets they have to worry about, and it's just let me explain to you. This is the math behind it. Now this is whole life. We're just going to use a 30-year-old healthy male who is going for a $250,000 whole life policy, which means if he dies, his spouse or his children or both get $250,000. $42,000 over that 20-year period to maintain this $250,000 life insurance policy. Now, inside of a whole life policy, there's something called a savings buildup. It's a savings aspect of it. Now, in the first couple of years, it doesn't build up anything. That's all gone to fees. But after a little while, then it starts to grow, and it turns into about $34,000. So after 20 years, it grows to about $34,000. But are you going to cancel it? If you cancel it, you don't get the $250,000 in case you croak after age 50. So you're probably going to keep going. So you keep going, you keep spending $178 a month. After 40 years, you have spent $84,000. You've spent $84,000 to maintain this policy. Now here's the good thing about the whole life policies on average, and that's what we're looking at. It's happening today. That savings does grow a little bit, and it grows up to be about $124,000. The cash value turns into, this is what's really amazing. Term life doesn't have a cash value buildup, so you're not paying extra for that. So when you buy term life here, because we're comparing apples to apples, it's going to cost you, over the life of that policy, $3,120 total. That's it. That's all it's going to cost you. $3,120 for 20-year level term. Now, again, there's no savings built up into that. So you've got to come into it with a long-term financial planning mindset. But that's pretty easy, because there's a bunch of things you're going to want to do when you're planning for your future. At 30, you might have a kid, or you're about to think about having a kid, maybe you're just getting married. But here's the things you're thinking about when you're 30. I'm going to get rid of my debt, so we're going to get rid of that. I have a 15-year mortgage on a house. 15 years is what we recommend, 15 years. Well, in 20 years, guess what? That's going to be gone. And your kids are probably $13 a month. So if you took the difference between 178 you're spending over here and 13, since you're going to spend it over there anyway, why not buy this and invest the $165? If you just put it into a boring savings account, and we'll just say it's not making any interest, and to age 70 are greatly improved. Just think about it. If you make it to age 50, your chances of making it to 70 or older have greatly improved. So you continue after this term expired. Now you take the whole $178 that you would have been spending on the whole life, and instead keep investing it. Keep going, and guess what it turns into after 40 years? $1 million.